Hey everybody, John here from Option Engineer. Welcome back to another episode. It is June 12th, 2018. We're going to do a quick little trade recap of my day's trading, and I'll kind of give you a little announcement and a little update on what may be coming next, at least is in a testing phase right now, but let's go ahead and dive into it and you'll get the teaser later. So I'm going to dive into my platform here. You'll also notice I'm doing this one as a pre-recorded video. I'm not doing it as a live video. And I'm running a test here because for some reason my video quality has been a little fuzzy and it drives me crazy as a technophobe to have fuzzy video quality. So I'm testing to see if maybe it's just the settings I have on the other program that I'm streaming with. But that is geeky stuff you don't care about. Let's go ahead and dive into the platform. So if I go into my activity tab here on the web platform of Tastyworks, and I go to my activity section here and I just look for today, I've placed one trade today. This was a adjustment trade. So the first time since I've been doing these recap reviews and I'm adjusting my trades. So we'll walk through the reasoning for that. It was a put. I rolled up my puts in Tesla, which was an iron condor. So let's go ahead and talk through the theory of that one. And I'll do that by duplicating the order and going to the table view here and showing you right now the stock price of Tesla has actually come down a little bit. So let's look at that first here. So on the 30-day chart, it must have been right here that I placed that iron condor. It was right before it took this meteoric parabolic rise upward. And so just today, it's starting to give a little bit back to the markets, but it's in that range of just kind of causing me to make a few decisions here. And let me show you what that decision was. So my original iron condor had the calls here at 335 and at 345, and my original puts were all the way down here at 255 and 245. So a good, I think it was an 80-point spread for the iron condor, which is fantastic, and that should give you plenty of room. But if it goes immediately straight up and to the right on the chart, it can test even the best of positions. So the decision I had to start making was that I was getting very low in my deltas on the put side. What that means is there's just going to be less trading activity, less opportunity for me to close out that position with where it was. It would have to kind of get to the place where there'd be no bid for that contract. So when you get down to that position, like for example, let me change this from delta and show you the volume of these guys. And let's see if that'll update. Looks like it's not wanting to update for me. Let's do open interest. There you go. So you can see there's still some interest here, but you can see it tapering off where these new strike prices here have, 2.3 thousand, 2.5 thousand, and here we're under 1,000 of open interest. Now, open interest and volume, we're not going to get into the technicals of what exactly those metrics are, but you want the numbers to be higher than lower. And what you can run into is if you don't adjust your trades at the right time, if you wait too late, as time ticks on, there's less uncertainty in the market, and so it makes less and less sense to have volume there because there's just less probability of that happening. So what you always want to do when you are making adjustments to your trade is try to manage your risk, number one. And in order to manage your risk, you need to take profits that the trade is giving you and kind of lock in that profit and then reintroduce that risk in order to take in a credit and expand out the break-even points on the tested side, or in this case, my call side is the one where the stock price is threatening and is kind of shooting through. So I want to try to do whatever I can without increasing my risk and without paying for it. I want to try to give more room on this side for the stock price to kind of travel. So to do that, essentially you want to close out the position you had that was profitable, which my put side was profitable because the stock price went up. And if I had just a normal put vertical spread, then that would be a profitable trade, right? But of course, the market being the market decided to push against me. So I wanted to take the profits here and then open up a new position, taking in another credit, right? So opening up a new position closer to where the stock is trading, but not too close. If you go too close, especially since we have 38 days to go here till expiration, if you go too close, then you can run the risk of the stock price reversing on you and then going straight through your put strikes in this case. And I definitely don't want to have that. So what I did, if I go and show this, instead of open interest, I want to go back to delta, which is a probability kind of estimate. I moved about to the 16, 17 delta on the short strike. It looks like it's at the 18 delta now with the continued down move that Tesla had today. But that kind of reintroduces a normal probability on the put side. You know, when you normally place them, if you're placing a 1 standard deviation strangle, then or iron condor, you're going to look between 15 and 20 deltas on the short strikes. So here I'm just reestablishing that same amount of risk, and you'll notice on the protection side, I'm keeping that same $10 width. So I'm adding nothing to my overall buying power reduction. I'm adding nothing to my risk, but I'm taking an additional credit. So you might think, oh, well, should I do this all the time? Not necessarily. And there's a little bit of judgment in this. I don't know if there's a single rule that is the way to do this, but what are you giving up when you make this adjustment? You know, that is really the question you have to ask yourself. What am I giving up by closing out this? And I'm making a pretty drastic adjustment here. So I'm going from 255 all the way up to 300 and 245 up to 290. So that's about a 50-point move, a 45-point move. If I'm not taking on more risk in terms of buying power, and I'm taking in a credit to extend my break even on the other side, where's the downside here? Oh, I'll show you. If I go over to my portfolio view and I take a look at this new position here in Tesla. So if you recall from an earlier video, the profit target window was very, very big. It was an 80-point spread between the short strikes. Now we have reduced that to, let me see if I can do mental math here. I've reduced that to a 335 to 300. That's a $35 window. So I've reduced my probability of profit potentially significantly in order to try to salvage the trade. So does that make sense? I hope that makes sense. Basically, the window is smaller. I'm taking in a credit, so I'm making this guy kind of taller and narrower. Okay, so now I can kind of draw on here. So my old profit target used to look like this. And so now by rolling up those puts, I'm closing this one and I'm closing this one and I'm reopening this one opening and opening here. So that's taking that credit. And if you look at my trade here, let me go ahead and go back to my window here. I took in a credit of $114. So making that adjustment took in $114, but it also opened up myself to the potential of, you know, future risk, right? Totally okay. There it is. Okay, so that's basically the anatomy of that adjustment there. So we'll watch this stock price. If this continues to go up, I'll be very happy I did that, because what will happen at that point is that these options here will expire, you know, pretty much worthless. And I won't really have a nice, easy, clean way of rolling them up. You know, so what happens? If these expire worthless, if I cannot make a trade on those two options here, then I'm in the position where in order to take on this additional credit, I would need to open a second spread, in which case having those two spreads here would increase my risk. So it's important, if you're going to roll the positions, to do it while there's still liquidity in the untested side of the spread. Okay. So that is the Tesla trade of the day. I'm going to also, just while we're on the line here together, let's go ahead and walk through my positions, because I kind of want you to see how low stress and low management this can be. Now, also, I will go ahead and say it's not the best. Let me go. Sorry, give me just a second there. So I'm also dealing, unfortunately, in a little bit of a drawdown. You know, portfolio is not at all-time highs right now. I'm down by $6 for the day, which is not bad. It started out with like -80. Oh, another good point on this. So my portfolio value started out showing -80 and then went up to, you know, about 50, and now it's back down to about flat. But here is part of the kind of mental math that you just need to have if you're trading options, is when I close that profitable trade, so, you know, these guys here, Having some technical difficulties here. So when I closed these guys here, they were marking a profit on my portfolio tab. So I by closing them, it really messes up your ability to properly see how you're doing. And so that's where having a spreadsheet like the trade journal that I share with you, or I'm playing around with using a new program as well to kind of track them across multiple roles. Using something on your own, it kind of is helpful as well. And also just kind of keeping in mind, at the end of the day, it's all about the net liquidating value. So keeping that one in check as well. All right, so Apple is sitting right there where I need it to. I'm up about 20% on that trade. So hopefully this guy will be a low stress option. Disney, on the other hand, he's also having some fun with me. I'm down. It shows down 60% on the trade. Really nothing to worry about. It's a wide trade, so watching that one. If it gets beyond the break-even points around here, I'll look at doing a very similar move like I did with Tesla. One thing as it's starting to get to this position I like to check on is if I open up the trade view for Disney and I pull up that position, I just want to see what type of liquidity is there already. So you'll notice this guy is at the 2 delta. So if the volume tool is working for me, it doesn't seem to be working too well today. This is where the desktop platform does have some serious advantage. I should just teach myself how to use it. Okay, so when I look at open interest, this is the last strike that is really showing some significant volume. So if I start to see that 1,000 start to drop below 1,000, like how this guy quickly dropped off from 1,000 down to 439, that's over a 50% drop in volume, it's going to be much harder for me to get that fill. And you can see here, there isn't a single bid for this option contract. So I would not be able to roll this one if I wanted to. So that's going to be on my radar if Disney continues to rally. But with there being 38 days left in the cycle, I don't want to over adjust what I'm doing here. All right, so let's keep going through the portfolio. That was my Disney trade. In emerging markets here, similar, where it's pushing the top end, but here you can really see the difference between defined risk and undefined risk trade. If I look at my EEM and kind of just take a note of where that is, and on my Disney trade, it's a little bit further out, but just for the sake of this argument, they're both in a similar position. Look at them together there. But you can see my EEM trade is up 30%, whereas my Disney trade is actually down a significant amount. So that does show you the benefits of undefined risk trades. I'm in my portfolio. I like to have a balance, so I'll be watching this one. But he is getting closer to closing out. I'll be looking to get a full 50% from EEM, so I've got some more time to go on that. EWZ, due to implied volatility changes, he's right where I want him to be, but I still haven't gained that much on the position because if I click on this and look at volatility, take a look at that guy. So let me expand this. So even though the stock price hasn't changed much at all, you look at that implied volatility, and there wasn't the same amount of price move to require that type of, that was one day, here we go. So we have had some drop in price, but even though my position's staying right where it needs to be, because that implied volatility spike, the pricing of those options have stayed pretty stagnant, and there's nothing to do. I'm perfectly fine with it, but it does take some time to let IV work itself out. FXE is kind of going along its happy way, nothing to do there. Gold position, similar, it's working nice and slowly. IWM is getting close to testing the call side as well. Because of liquidity, I won't even need to check this. There's plenty of liquidity there, so if I need to make adjustments, I can. This is my combined iron condor and iron fly position, and you can see it's kind of working out quite nicely. Up 10% on the entire combination. But you can see here, the first combination's at about 8%, the second's at 16%, I'm pretty sure. Yeah, the iron condor is at 16%, the iron fly is at 8%. So those are going to work slowly. They're defined risk trades, so I'll just be patient with them. We just talked about Tesla. My USO trade is working its way through. It's starting to move up a little bit, but I'm about halfway to my profit target there. XLE is almost ready to be taken off. It's at 40%, just 10 more to go. XOM is also with the general market move. You see a lot of my positions have that positive drift, that positive, they've moved in the positive way, so I have a negative delta in my portfolio. So a down move would be very nice for me right about now. And then XOP, again, is doing pretty well. So all in all, My portfolio still has a good normal distribution, a normal curve there. But because everything is kind of skewed a little bit positive, I would really like about a 10 point down move here, which would bring me right back to that center point of the normal distribution. But I don't need to kind of worry or overact. I don't need to put on a bunch of negative delta trades right now, because if I put on negative delta trades and I get the move that I want, then I can overcorrect as well. So by having individual management targets with each of my positions, I'm able to handle that kind of naturally without having to put too much thought into it. Okay, so those are the trades. I hope this is helpful for you guys. One thing I want to go over now is kind of a little test trade, and I put this out on the Facebook group, so you probably saw it, but I am testing a very small amount here in Robinhood. And if you haven't heard about it, you can go to robinhood.com, but it's a pretty interesting new brokerage that's coming on the market now, and their big differentiator from Tastyworks as well as anybody else in the game really is that there are truly zero commissions on their fees. Because they're a tech company first and a finance company second, they've streamlined their process to the point where whether you're buying, selling stock or options, there's $0 to open it and $0 per contract. And it even extends to assignment and exercise fees, which normally tack on $10, $20, $30 to every contract. There's no exercise or assignment fees in this brokerage either. So all that sounds incredible. So what are the downsides? Well, it's a very new platform. They've just released options trading in the past 6 months or so. But as you can see here, I do have 3 positions on that they're all defined risk trades, and I'm just kind of testing it out, testing the waters, if you will. But what's nice about it is, even though I only put on a trade with I took a credit of $21 on a 1 point wide spread. This is really just for me to be curious and to test it out. All that, if I win, all that is profit versus giving up, $5 in commissions or $2 to open, $2 to close. It all comes out. And if I were to get assigned, it doesn't really take away from my P&L. So very interesting option here for traders that are coming on. One thing I'll tell you right now is, you kind of see over here, options trading is coming soon. So don't know exactly when soon is, but if you're going to be focused on defined risk trades, this could be a pretty decent way to go. And the reason why I say focus on defined risk trades is they currently do not have, to my knowledge, the ability to margin your portfolio in the same way where Tastyworks can take about 20% of the notional value, being the stock price times 100, and basically comp you or take the risk on your behalf of leveraging your portfolio using naked options. Robinhood doesn't do that, and I think it's very wise of them not to do that, because it only takes a few idiots to blow up their accounts, and then all of a sudden Robinhood is in trouble because they're on the line for all that margin. But they do allow you to trade spreads. So here you can see an example of a Q's trade I put on today, and it will define it for you as an iron condor correctly. This is just a 1 point wide iron condor with $10 wide wings. And I put this one on for $491. I'm still getting used to reading this interface here, but I put it on for $491. I'm looking to take about $200 out of it. And with it being a $10 wide, my risk to reward is quite nice. I'm going to manage this as an iron fly because it's really only 1 point wide. So we'll see. I'll kind of include you in this journey as I'm going through. I'm using the same management methodology as I have on Tastyworks. And there you go. Whenever the market closes, the interface changes from white to black, which is pretty nice contextual. It's just a very cleanly designed app, which I appreciate. But ultimately, I need to become a better profitable trader for it to be worth anything. So that is kind of the mission that we're on here, and I'll take you along with me. So I hope this is helpful. Until next time, trade smarter and be happier. Take care.